Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Brooke Thackeray, research analyst at Global X, will be joining us for the hour. In 30 minutes, Science and Humans, a Canadian startup focused on hormonal health, will close with an oversubscribed $10 million series this year. Its founder will be here to tell us more about the company and their future plans. And of course, we want to hear from you this morning on First Call. Reach out with your questions, and we'll have Brooke answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes, and our email address, of course, if you want to do that, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Dollarama missed estimates for fourth quarter same-store sales. The discount store says unfavorable weather conditions negatively impacted store traffic. The Montreal-based company notes it did reach new customers through the opening of 75 new stores, and the company also raised its dividend by 12 cents per share. Boralex confirming it is conducting a strategic review of the company. According to Bloomberg, the renewable energy company is also weighing a potential deal to go private. The Montreal-based company is working with Canadian banks to handle proposals, according to people familiar with the matter. The deliberations are early, and the company could still decide to remain public. Estee Lauder is in talks to buy Pug Brands in a deal that would create a cosmetics giant with about $20 billion US in annual sales. A takeover of the Spanish company would give Estee Lauder access to well-known perfume and fashion brands like Rabanne and Jean Paul Gaultier, helping it compete against rival cosmetics company L'Oreal. For Pug, the move follows slowing growth and downgrades of earnings estimates. And now our top-line story. Stocks continue to fluctuate as traders grapple with a range of possible outcomes for the war in the Middle East, with oil prices remaining elevated as the fighting continues. To help us make sense of the markets, let's bring in our guest for the hour, Brooke Thackeray, research analyst at Global X. Brooke, thanks as always for joining us. And you're going to have to make sense of the Middle East.
I don't think anybody can make sense.
Go. I mean, I was looking, last time I saw, I think oil prices were up slightly today. Yeah. They had a roller coaster yesterday. I'll leave it at that. I don't even know what to ask you at this point with it.
Right.
I mean, what's next?
It's difficult because the messaging is all over the place from the U.S. in particular, but also from Israel, from Iran, and there's three parties involved. And we can't react on a knee-jerk reaction to one headline or one country stating something. This is a multi-party thing, and it's very inconsistent, the information coming out and what could possibly happen. I still think that this isn't over. You know, we saw the markets rally yesterday on the announcement.
Yeah, Trump saying we're in talks, they're going well. Then the Iranian media saying, what are you talking about?
Yeah, and I personally think that really was Trump just indicating more of a positional statement saying, hey, I'd like to talk, more than anything else. But I think we have to look at the actions more than the words themselves. And as far as the energy sector goes, we've seen the energy sector on the stock market do extremely well since January. So it actually started to outperform before the war started. And as oil went up, it did well. But it hasn't become like crazy expensive. I mean,
it's kind of calm. It feels like it's calmed down again.
It's calmed down again. It's not like it's had this huge run that's got, yes, it is overbought a bit. But even if we did see it pull back in this noise with everything that's taking place here a little bit, the price of oil pull back here a little bit, I wouldn't see the floor falling out here. I still think there's more upside for the energy sector as we go forward because, you know, in the end, even if a peace deal was signed, then it has to be put in place. Everything, like the whole supply infrastructure is in shambles right now, and moving stuff around, and wells have to be repressurized, and maintenance needs to be done. All of that stuff has to be done, and that takes a long time. This isn't you flick a switch or you turn a tap and everything's back to normal. So there's still a lot of pain regardless.
And now you mentioned that you don't think the bottom's going to fall out, but what about the other way, a spike? What would drive that, do you think, at this moment? I mean, there's optimism right now, but if they started targeting more energy infrastructure, would that be?
Yeah, I think that's definitely a big driver if we start to see that happen, and that could happen. And if they keep the Strait of Hormuz open, closed, I should say, for another couple weeks, I think all of a sudden, as we get closer and closer to that time period, because right now we're seeing unsanctioned Russian floating oil, so oil in ships, 140 million barrels, and we got unsanctioned Iranian oil, 130 million barrels. That's providing a little bit of a buffer and release from the SPRs around the world. But as we go through that storage and extra buffer, and we get close to the end, if the Strait of Hormuz is still closed, then we're going to start to see the price of oil start to re-accelerate again. For a spike, if we start to see some big infrastructure hits.
And now, globally, we're seeing, China, India, I think, are really feeling this right now, the reduced oil flow. Is there any chance that it might come to us at all, or no, because we have so much oil here and capacity here?
No, I think we're pretty well immune to it. So we do actually import oil here in Canada and natural gas on the East Coast.
Yeah.
So there could be some regional effects that could happen.
There was that ship that came in from Australia earlier this year.
Yeah, I know. I know. I don't know what to say on that one, but it was kind of crazy that happened. So, but that just illustrates that it's a world market a little bit, but we're definitely insulated. We're not like Australia. If you take a look at Australia, Australia's in big trouble. If they start to, their shipments of refined gasoline start to drop off here, which could happen from Asia because they're coming from Asia, they could be in huge trouble. And that, a couple weeks out, I don't know the exact timing of that. So we might actually start to see some rationing start to take place in different countries. I think one country's already started to implement that along the way, but that's all in the eastern part. But I think North America, we're pretty set from that.
What might we feel, though, from that rationing in Asia? What might we see? Products not arriving here or being delayed, or prices rising because of that, because of the shortages they're facing there?
I think, sure. The price is going to rise because of the oil price going up, and that's going to definitely affect it as well.
Could we see shortages of products because they can't produce, or they've scaled back?
I think that would be much further down the road. I think the rationing more would be like, hey, you can only drive on certain days if your license plate number ends in this or whatever it is, and start to really cut back on the consumer level. So I don't think they'll cut back at the manufacturing level, because you're right, that would do way too much damage for the country. So I think it's more of a, hey, let's just try and cut back the usage on the discretionary basis. Down the road, if it got really bad, that could happen, where companies have to start doing some sort of curtailment goes. I don't see that right now as a plan out.
There's enough oil out there that we can keep moving with that stuff.
Yeah, I think so.
Okay, we'll wrap it up there for now. But up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets right now. We'll start with U.S. futures, and it's going to be a bit of a day of searching. They were up a little earlier now. They are all off by about 0.3%. Dow, NASDAQ, and S&P 500 as everybody figures out what is next. Heading to Asia, and they were playing catch-up from yesterday because they were closed by the time that news broke about potential talks. And today you can see they're reacting to that. Nikkei up by 1.4, the Hang Seng 2.8, and the CSI 300 by 1.3 roughly. Heading over to Europe, and it's much like the U.S. futures, a bit of a mixed bag. Unsure. You've got the FTSE up slightly, the CAC 40 pretty much a wash, and the DAX off by 0.34%. And the TSX from yesterday. It finished up 1.8%, still down for the month, about neutral for the year. Some of the winners and losers from yesterday. Look at Transcontinental, almost 44%. Abra Silver, 10%. International Petroleum going the other way, 4.5%. And Vermilion off by 6.25%. Taking a look at the metals. Gold and silver. A little bit of a reality check for them. We're going to talk more about gold. It is up today by 0.1%, but still, look at that at 4,400, 44.44. Silver down below 70 now, and it's up as well, but still down below 70. And copper off today by more than 1% at 540. Western Canadian Select yesterday, and that's on the news from Trump, of course, dropping 11% to 72.91. And today, there's a bit of a bounce back for WTI. or there was earlier. Let's see what it's doing right now. Can't say there wasn't because it changes so quickly. But yeah, WTI bouncing back a little bit today, up by 3.7%, over 91 a barrel. And as we were talking about, gold has edged up as investors take stock of the sell-off. It has seen the metal tumble more than 15% since the start of the war in the Middle East. For more on the metal market, let's turn to our guest this hour, Brooke Thackeray, research analyst at Global X. And what a turnabout, because everybody was all excited and loving gold, but it has not responded. Would it be a traditional response? Usually gold goes up with something like this?
The typical...
or is that the old traditional response?
I think it's the old way, because you saw in the past, people would say, well, gold is a safe haven. And when geopolitical events transpire, gold would go up. And that, I think, decades ago used to happen a lot more. When Russia marched into Afghanistan, we saw that take place. Mm-hmm. But even like in the Iraqi war, that back quite a while ago, that didn't happen so much. And we're seeing that's not the response. Gold really trades off of other things, such as currency debasement. And the fear with the geopolitics is that, well, if a country goes to war, that means you're going to have to print more money, causing more inflation. Therefore, the currency is going to go down in value. So therefore, gold's going to go up in value. That's the ultimate. Mm-hmm. That's exactly, the change.
How it should play out.
Yes, how it should play out. But in the short term, it can have some ups and downs. And what we're seeing here is we're seeing the U.S. dollar go up a lot very recently and quickly. And speed matters in the currency markets. When the currency U.S. dollar goes up a lot quickly, that really has an impact.
Just looking to see what it's up. It's up again today, quarter point.
Yeah, so there we go. It's been rising for a while, and it's really accelerated that. Interest rates have also been going up. So those two factors in combination have really pushed the price of gold down when those two things happen. And the other thing that's happened is, when the market's in trouble, investors sell what they can, not what they want.
No.
And gold's fairly liquid, and they're saying, well, and we've got huge profits in it. We've had a huge run, so let's sell out of that. So that's really what's happened. Hasn't taken away from the long-term case. The long-term case is still there.
Yeah.
Governments are still spending money.
They're still buying gold, right?
In fact, governments are still, central banks around the world are still buying gold out in the East as well. I mean, maybe in the Middle East, you might have to see some of the Middle Eastern countries slow down their purchases of gold, because now, with everything being disrupted, less money coming in as repairs have to be made for infrastructure or something. Mm-hmm. But so there may be that factor. But overall, net, we're still seeing everything that was driving gold before still in place. I think we're probably going to see some sort of bottom in this area here. I think the U.S. dollar has gone up, and maybe it continues to go up, but it won't go up as fast.
Because it was on a decline for the last while, right? And then there's been this spike since the war.
Yeah, so the U.S. dollar started to pick up its strength in January, a little bit before the war, and then it's really accelerated quite fast since the war, basically. Mm-hmm. And I think that's going to, I think we're still going to see a stronger U.S. dollar in the short term, but not the same pace as well. And interest rates, they're probably going to settle out here a little bit as well. So I think the focus will now go back to gold a bit. I don't see it all of a sudden running away. All of a sudden, it's like, hey, let's go back to the all-time highs. I think we're going to be in a consolidation range here, but I think we're probably in some sort of bottoming pattern, and we're probably close to the bottom of that. So I think that's good news. I think we could see the precious metals, gold, actually do okay from here. Not fantastic in the short term. Long term, I think it's going to do great.
Yeah.
But we could actually start to get a base.
And I think people, though, who have invested in gold have to remember it's been a good run.
Oh, it's been a fantastic run.
Yeah.
Absolutely fantastic. And gold's done exactly that. It's had a rally, and then it consolidates for a while. And we saw that over the last few years, and we saw that even in 2025, early 2025, and then it breaks out and runs again. And we've just seen it pull back here again, and it's in this consolidation phase. So I wouldn't be surprised to see it stay in this range for a little while.
And what kind of an impact will that have on gold miners?
Well, gold miners are a leveraged play to gold. I think that they've really got beaten up. I mean, gold's come down, as you mentioned, 15% since the start of the war, but gold miners have really been hit quite hard. I think gold miners are also going to settle out here and start to put in a base and start to do okay at this level here.
All right, and the other wild one is silver. It's back down to reality. Not quite fully down to reality, but back a lot. Is that going to continue with silver, do you think?
I think we may see a little bit more downside for silver here, but I think it's in the same camp as gold. It's being sold off. A lot of that hot money where investors were coming in and just doing the trade, those investors tend to leave. They get in quickly and they leave quickly.
Like a storm.
Yeah. And they don't really care so much about what the underlying is and more about the trade. So we've seen those get washed out. The long-term holders are probably, more so here. The demand for silver is still strong. We're still solar panels, all the requirements for that. We're still in a deficit. We've been in a deficit for 5 years. All the fundamentals are there. So I think we're probably going to start to see a little bit of a bottoming pattern in this level here.
All right, we're going to take a break on that note there. But up next, we'll be back with Brooke Thackeray, the research analyst at Global X, to see why ARC Resources is on his radar. Time to see what's on the radar for Brooke Thackeray, research analyst at Global X. And first up, ARC Resources, heavy oil, seeing a benefit right now with everything that's unfolding, aren't they?
Yeah, so what we're seeing is the emphasis is all about heavy oil, but ARC Resources also has a lot of natural gas. It's a gassy company. And so it can take advantage of what's taking place here. So with LNG Canada now expanding out, in the future they're looking to put 25% of their oil, their natural gas, I should say, through international markets. And they already have some access to the States and international markets. So longer term, this is a good thing. And if we take a look at the damage that's been done to the infrastructure at Qatar, I mean, this is going to take 5 years to rebuild.
Yeah, they're saying 3 to 5 and 20 billion, 24 billion, something like that.
Just huge numbers.
Yeah.
And so that there's going to have to be replacement for LNG. And so ARC Resources will be able to help fill that later on. So this is a very positive for a company like ARC Resources, just because they're going to get more and more exposure to international markets over time.
Now, do we have the capabilities to expand that, though? Or do we have the time to expand it? Like where people will say, all right, you know what, everything in Kuwait's fixed, or everything in Qatar is fixed. Let's just go back to them. We know we're going to get it from them.
Yeah, so as far as the LNG pipeline goes, I mean, so the commitments are already being there for ARC. So they can take advantage of that. As far as extra capacity for us to ship out, we're well behind the U.S. We've lost a lot of that opportunity as far as that goes. But to Qatar, their production is really going to be hampered for a long time. And who knows, maybe it actually even gets worse here. We just don't know.
All right, let's move on. SLB. I was looking at is it software? Did I look that up right? No, I was looking at something different. Just ignore me. I was looking at I'm mixing names up. You go ahead and take over from here.
It's the old Schlumberger. They rebranded SLB, NV, but it's just called SLB. So they're the world's largest oil services company. They also have the offshore drilling as well. And so you got two things that are really affecting the price for SLB. And the one is that they're doing the oil services, and so they're involved in the Middle East. And you just saw Citigroup actually put out a buy on them, and the reason is they're going to benefit from all this. They're going to have to help rebuild that facility, basically. All the infrastructure is being damaged in the Middle East right now as far as oil and gas goes. So they're going to have, this is stacking up their backlog, basically. Yeah. So that's a huge benefit.
Which is a good thing to have.
Which is a great thing to have. On top of that, they get a large source of the revenue from offshore drilling. And that's, as we see the fracking really start to peak in the U.S. is going to start to look for more and more opportunities for revenue from oil. And one of them is going to be offshore drilling. So Venezuela, Brazil, Guyana, there's even talks about Cuba as well. So who knows what's going on there? I don't want to speculate, but there's a lot more opportunity for offshore drilling as well. So that would also help SLB at the same time.
All right. And I was just looking, they're having huge interest in it. People are Googling SLB a lot right now, according to Bloomberg. They're saying it was unusually high, the search for stories on it. So
yeah, that could be because Citigroup yesterday came out with a buy on the stock. The stock was up 6% yesterday on the news, and because it actually makes a lot of sense. Taking advantage of two different opportunities.
All right, and the last one I want to talk about is an ETF, the BMO SPDR Healthcare Select Sector Index.
Yeah, so the ticker symbol for that is ZXLV.
Okay, we don't have the graph for it, people, if you're looking for it. So
yeah, but I'm just saying. So it's XLV is the Spider ETF in the U.S. XLV, and BMO has the rights to that in Canada. So they put the ticker symbol Z in front, and so it's a great sector right now. The sector is being beaten up unusually hard, actually. If you take a look at the strength of the healthcare sector, they're the ones that are actually providing most of the jobs in the job market for the state. So the healthcare sector is doing well, but the stock's actually been pulling back. The sector's been pulling back here, and which could provide a good opportunity. It's become extremely oversold. With rising interest rates, that's actually hurt the sector here. If we start to see that slow down, the sector could be a good diversifier in a portfolio. So if investors have other aspects in their portfolio, tech or energy or whatever, this would be the defensive play, one of the top defensive plays in the portfolio. And with the BMO product, they have the hedged version and the unhedged version. You get to buy it in Canada as well.
All right, and you feel that market settled down, and because I think people reacting, they keep hearing things about it and keep hearing that we have to go to AI, and so they're just staying away from it. Yet it's pretty solid for the most part.
Yeah, I mean, so that's just
it's volatile right now, but pretty solid overall, though.
Yeah. So if you take a look, I mean, I call it the shiny ball syndrome because everybody's focusing on AI and only AI, and so now we've seen focus on the energy sector as well. And we're seeing that being transferred around a little bit, but inside a portfolio, if you're building a portfolio, you can't have all AI and you can't have all tech and you can't have all energy as well. And the defensive sector, XLV, the healthcare sector, can actually do quite well on a seasonal basis at this time of year. So is adding a diversifier in there that is a little more defensive, that's become oversold in this environment, can help provide a diversification value, basically.
All right, we'll leave it on that note there. Still ahead, though, a Canadian startup closed an oversubscribed $10 million Series A this year on its work in healthcare. We'll find out what its healthcare platform is, and our phone lines will open soon for our first call segment. Call us at 1-855-326-6266. Send us an email, first call, bellmedia.ca. AtkinsRéalis has received a contract worth approximately £98 million from Britain's rail infrastructure owner Network Rail. The Montreal-based company will work to upgrade signalling and telecommunications infrastructure in South England. The engineering services company will deliver end-to-end design, project management, and construction services over 3 years. Agricultural land prices in Canada continued to climb last year. However, some regions saw more of an increase than others, according to a new report by Farm Credit Canada. Farmland value rose more than 9% in 2025, extending a 3-decade upward trend. Federal Corporation says the market was supported by farmland's long-term investment appeal, tight supply, and strong competition among expansion-focused producers. Dollarama missed estimates for fourth quarter same-store sales. The Montreal-based company also raised its dividend, which came in slightly below estimates. The discount store says unfavorable weather conditions negatively impacted store traffic during peak sales periods. Dollarama also added it reached new customers through the opening of 75 new stores. And taking a look at the U.S. futures, you can see it's been a bit of a bouncy day. They were up earlier on, and now off about the same by about a quarter point as everybody figures out what's happening next. Hormone health may be a major focus in the future of healthcare, as one Canadian company stands to prove after raising an oversubscribed $10 million Series A to scale its personalized, data-driven approach to treating hormone-related conditions. Here to share more about the company is Hira Siddiqui, founder of Science and Humans. I guess I should say co-founder here, but thank you very much for joining us today. We appreciate it. Tell us a little bit first about what your company is and what the focus is.
Thank you for the opportunity, and recognizing hormone health as a category is a great start and a great point to start this conversation. Science and Humans is Canada's largest digital health platform that specializes in hormone health for both men and women across different life stages. And our approach to delivering care is very unique in the industry. And that is essentially why we are becoming extremely successful in doing what we do today. We combine clinical protocols with wearables, insights, and biomarker data to deliver hyper-personalized care digitally at scale. That's essentially what we've been doing for the last 5 years, delivering care both direct to consumer and through large insurance companies and other distribution channels.
What's your major target market? Is it the end consumer? Because the end consumer is becoming more and more interested. Hormonal healthcare is hitting the news in a big way here, or is it the healthcare companies?
It is the end consumers in our D2C, distribution channel. Consumers are buying our services directly on our e-commerce website. However, on the B2B side of our business, our consumers, the customers are large insurance companies and large employers. Of course, the healthcare consumers are employees of those organizations, but in that channel, essentially the healthcare services are purchased through insurance companies and employers, so both.
Now, you say you cover both male and female and a broad age. Are you not worried you're spreading yourself too thin trying to do it that way?
It's a really great question. We started off in a certain demographics of the market. We didn't start off with providing solutions across different demographics. As we scaled and the infrastructure built over time, both in terms of technology and scale, and our medical team exposure and expertise grew over time, we saw that the need was very well required across all different life stages, and both in men and women. The challenges are quite unique and different. And at the same time, there were challenges experienced by all of these demographics looking for evidence-based solutions in the market and seeing significant challenges in doing so. So over time, our organic growth strategy allowed us to cover all demographics and then both males and females. But we started off doing midlife first and then grew from there.
What about regulation? Is the regulations becoming more friendly, allowing you to do more of this, or is the government starting to really clamp down in this area as it grows?
No, we find ourselves extremely complementary, not essentially competing with the services available through the community providers today. There is a gap that is recognized both by the regulatory and through the B2B channels, insurance companies and employers, since they are very evidently today experiencing and observing productivity loss in their workforce and in employees. So we actually find ourselves extremely complementary, and we have so far not experienced any regulatory challenges.
And going back to your $10 million, the Series A, what made you decide on $10 million? And you oversubscribed, or were you surprised to see that?
We were not actually surprised to see that. Our journeys, I can, say that perhaps was a little bit different and easier relative to some of the other founders. We had been in this space for a few years. So essentially, we had a proven track record of execution. The traction was there. We had some of the largest contracts with major insurance companies in Canada, and over 60,000 members on the D2C channel had already subscribed to our services. So we had a very healthy P&L. We were a cash-generating business. The requirement for the fundraise or the Series A was essentially to bring the money to fund our next stage of growth and really build that next generation experience in terms of technology and infrastructure that consumers are looking for in digital health solutions today. But in terms of our subscription round, it was very well expected, and we are very proud to have some of the largest, most supportive investors today in the healthcare segment and industry today in Canada.
Now, you cover a wide target market. Are you finding there's more young people being interested in this? Because hormonal health used to be more of a concern for older people, but I get the impression that younger people are starting to get more interested in this.
That's a really good question. So I'll break it down into two. Especially, it's very evident and perhaps commonly known that hormone health does decline with gradual and natural age progression, both in men and women. So the demand and the requirement for hormone health evidence-based solutions is, of course, is a proven model in midlife and beyond. But on the younger demographic side, younger women in their 20s and early 30s do experience an entire spectrum of hormone health conditions as well, with PCOS, PMS, PMDD, infertility-related conditions. And those are all conditions that are experienced by younger females. And then on the younger male side, it's not very frequently spoken, but there are many different reasons why younger males are also starting to experience hormonal dysregulation because of the endocrine disruptors in our environments today, with stress and lack of movement and exercise and nutrition. These all essentially can become contributors to suboptimal hormone health conditions in younger males as well. So we have essentially access to some of the most brilliant minds in the industry in terms of medical advisors that are top endocrinologists, gynecologists, regenerative medicine experts that help us build these solutions that are extremely evidence-based. So we have protocols that are built both for younger males and females, and then midlife and beyond individuals as well.
Okay, Hira, we have to wrap it up there, but thank you very much for joining us.
Thank you very much for the opportunity.
Hira Siddiqui is co-founder of Science and Humans. Still ahead, today's market drivers with Bloomberg's Divya Balji, and our phone lines are open. Brooke Thackeray, research analyst at Global X, is taking your questions. You can reach us at 1-855-326-6266. And of course, you can email us, first call at bellmedia.ca. Well, for a look at some early market movers, we are joined by Bloomberg's managing editor for breaking news in the Americas, Divya Balji. Divya, thanks as always for joining us. We'll start off with SMFG and Jefferies. Are they going to get married?
Yeah, I have to say, I was quite surprised when I saw the FT article basically talking about how SMFG is working on plans to potentially buy or put an offer out for Jefferies if its share price keeps falling. I mean, as you know, we've seen a lot of market volatility in the last few weeks, and that's also, giving a huge hit to a lot of these companies that are out there. Now, this story is obviously a very big deal. Jefferies is quite a big bank in the U.S. that a lot of people pay attention to. It is a partner with SMFG or with one of its subsidiaries, so that also makes a difference. I believe SMFG or its subsidiary has a stake in Jefferies as well. Now, SMFG has come out to say they have no immediate plans to make an offer or buy out Jefferies. Jefferies has not responded to this story at all. I mean, I think there's a lot of nuance here. SMFG could be working in the background and paying very close attention to Jefferies' share price, but maybe there is no official offer or no official plans to get that deal out there. But certainly something that we are hearing about and seeing when it comes to these two companies. It's also a possibility that we see a lot more of these types of offers come in terms of M&A opportunities if, a lot of companies out there with great revenues and great profit could actually see their share price drop to a point where it might be better for them to get bought out.
All right, and something important to me, makeup. Estee Lauder in talks to buy Puig.
Yes, important to me too as well. This is also another interesting one. Estee Lauder has confirmed that they are looking at possibly making an offer for Puig. I think what could happen here is this could potentially create a big giant in the industry with about $20 billion worth of sales. It could also really rival and compete in a big way with the largest cosmetics maker or cosmetics company in the world, L'Oreal. And also, one of the other things that the market's also talking about, or analysts are talking about, is this actually a good deal for Estee Lauder? I mean, if you think about it, this is a company that has been going through quite a bit of a business turnaround at this point. Is now the time for them to get distracted in a rather large acquisition? They would be taking on about $5 billion worth of sales. Now, from the Puig standpoint, a Spanish company here that went public in 2024, its share price has really suffered quite a bit since it's gone public. There is slowing growth. Earnings growth hasn't been very strong. Earnings estimates growth also hasn't been very strong. So possibly this is a way to get out of that through an M&A deal as well. Nothing has been set in stone yet. Puig shares are reacting very, very positively to the news, up more than 17% at one point this morning. So, it is still a possibility. This one is a bit more clear than the SMFG and the Jefferies one. Estee Lauder has come out to confirm that they are trying to work on this right now. So the question is whether or not they will go through with making a deal or offering a deal to Puig.
All right, we'll wrap it up there, Divya. Thank you, as always. Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls. Excuse me, I've got a frog in my throat there, including First Majestic Silver. Let's take a look at some of the notable analyst calls and recommendations. First Majestic Silver shares are up in pre-market trading as BMO Capital Markets raised its recommendation on the miner to outperform from market perform on an attractive valuation. Analyst Kevin O'Halloran sees First Majestic shares as currently discounted compared to historical ranges, PT set to $35 Canadian. Ralph Lauren shares also rising in the pre-market after Citi upgraded the retailer to buy from neutral, saying that the company's efforts to elevate the brand have driven strong performance. Analyst Paul Lejuez says that there is more to come, and he has increased confidence that the momentum in the brand can continue. PT set to $400, implying an 18% increase from last close. And JFrog shares leaped up in pre-market trading as UBS upgrades the software firm to buy from neutral following recent stock weakness, with the analyst noting that there are no signs of slowdown. Analyst Ratty Salton also says concerns about a disruption look overdone. The PT is set to $60. For more on this, let's bring in Brooke Thackeray, research analyst at Global X. Brooke, which one are you liking there? Why do you like it?
Well, I think for First Majestic, it's been badly beaten up over time. Mm-hmm. It's been an underperformer, and its valuations have become quite attractive relative to the opportunity on a go-forward basis. First Majestic does have higher costs per ounce than some of the other silver miners, but so they've been punished a little bit on some of this downturn, even before we've seen this pull back here in 2026. So I think the valuation for First Majestic is very good. I think the industry is very good. There's huge silver demand. Yep. As I mentioned earlier, there's a 5-year deficit that's been taking place, and we're expected to continue with those deficits. And First Majestic is in a good place to take advantage of that. So I agree with that assessment.
All right, we'll wrap it up there, but we've got lots more when we come back. Brooke, who's a research analyst at Global X, will take your questions on First Call. Time for First Call and first email, and that email comes from Mike. Like to get Brooke's outlook on SLF, Sun Life Financial. Thanks.
I think Sun Life Financial is in a good place right here. So we're seeing rising interest rates at this point, which is a plus for the life insurance companies. So we have seen it pull back here a little bit, down to really a support level. Rising interest rates are going to help Sun Life, and I think this is the time to be looking at more defensive, not necessarily totally defensive plays, but that Sun Life would fit that category. Basically.
Anybody else in that sector?
Well, Manulife would be the same as well, generally speaking. But so both would fall into the same, fairly defensive in this, benefiting from rising interest rates at this time.
And is there either one you prefer? Either?
I think both. I mean, there's going to be some differences about, with Sun Life having more exposure to the east, et cetera. But I think both of them are good. I think the big differences are when you start looking at some of the Canadian life insurance companies versus some of the U.S. life insurance companies, and that's a totally different market. That's where you have to be concerned with the big differences.
And what's the concern?
Well,
with
some of the insurance companies in the States, not the big ones, but have actually been bought out by private credit.
Mm-hmm. Oh.
Yes, and there's reasons for that. They've shuffled off some of their assets to the life insurance companies, and so it's become quite opaque. And the reporting for life insurance companies is a little bit different. It becomes this big, huge muddied thing. So they've used the life insurance companies as a conduit for opaqueness. So it's a little bit different for some of the life insurance companies in the States.
All right. Let's get to another email. This one from Roger. I would like the guest's opinion of ZLB, and would this be a good time to leg into a position?
So ZLB is the BMO low volatility ETF, which has done well over the long term. I think this is actually a good time for low volatility positions because we are seeing increased volatility in the market. So you're going to find low volatility stocks tend to do better in this type of environment. And I do expect more volatility in the market on a go-forward basis, and particularly as we see movement away from the growth sectors in the market towards the value sectors. And what you're going to find is in the low volatility sector, you're going to find more value than growth. So I think this is actually a good place to be right now.
What percentage?
It all depends on the specific, objectives and risk tolerances and whatever. But it's a fairly conservative play in the market, so it can be a bigger percentage versus, let's say, something that's more speculative, as an example.
Okay. Next up, this email is from Kevin. Can I have your guest's opinion of MDA space? Would it be a buy at this level? Lots going on with them.
Lots going on there. But I still think that this is going to be a big driver for the years going forward. On a seasonal basis, they tend to do well this time. Here, we're back up to where we were really last August. So we could see a much further increase here. The MDA space is going to be a recipient from government spending, and we know that's going up. And we know where they're spending their money as far as defense goes. So MDA space is going to be a huge play on a go-forward basis. And I don't see that changing over time. So I think this company can still do well despite its rapid run, really, over the last few months.
And there was a lot of interest down in the States with them. So.
Oh, absolutely, yeah. As they've expanded into the States to get more capital, that's actually helped them out.
All right, next email is from Ryan. And Dollarama reported earnings today. Are we seeing the effects of the K-shaped economy here?
Yeah, a little bit.
That was a very long pause.
A little bit, because, I've been talking about the K-shaped economy like others for a long time on this. And the K-shaped economy is basically a reference to the lower income groups of really struggling, and the upper income groups still doing okay with international travel still hanging on. So Dollarama is in this really interesting position where they service a lower income clientele, but they've got an extra market now that actually they got the higher incomes that are actually shopping in the lower income stores.
Yeah.
So
I was trying to find that article, and now I can't find it again. They're seeing a rise in that.
They're definitely seeing a rise, but that's been anticipated. That's been going on for a while, where we've seen this downplay. That's actually McDonald's has commented on the same thing. They're finding more higher income people coming into McDonald's as some of the lower income groups actually struggle a little bit. But it wasn't enough for Dollarama here. So maybe there's just the expectations as far as that goes. They had a miss on their sales. So I still think it's a good play on a go-forward basis. And I still think we're going to see more upper income struggle here. I think we're starting to see that space in between the lower and the top, K's on the arms, that space there with income earners, more and more getting shifted down. So I think we're going to see more shoppers from higher income come down, because I think we're going to see more struggles with the higher income group. So I think Dollarama is well poised to take advantage of that over the long term.
So you think this might be more of a blip than...
I think so. Absolutely.
Not
I
to
think
put you
so.
on the spot, but
yeah, no,
it
absolutely.
seems like that's the way you're looking.
Yeah, that's exactly the way I'm looking at it. This is a little bit of a blip because the longer term fundamentals are quite positive, because I think more and more people are going to be shopping at Dollarama as we find unemployment going up here and the economy slowing down a bit.
And they don't really have any, they have some regional contenders, I guess. I think of something like Giant Tiger. But who else is there really? There
are some, it's a very franchised, structured industry. And what you've seen is the accumulation or aggregation of some of these stores. But still, they have a lot of local stores that actually compete as well for that dollar value and whatnot as well. But they are a dominant player.
Yeah. And they moved into Australia, right? Did they not? Did I see that? Or am I going insane? Don't answer that question. They moved into Australia. They're buying, I forget what the name of the store there. It's a great name down there. So they're expanding. Obviously, they've got some confidence going.
Yeah, like I said, I think they're well positioned with their merchandise, their price points. They've expanded their price points up over time as well, from $1 now they're higher, and they push those prices up higher and higher to fill that segment. And I think that you're going to see more expansion of that as well over time. And what they're doing with Australia is they'll be going off and buying another company and setting up down there and trying to tap that market, that demographic, as we find the same K-shaped phenomenon taking place in Australia.
All right, and it's called the Reject Shop. That's what I was trying to remember the name of it, and Paula, my producer, whispered it in my ear. So we'll wrap it up on that note, though. Brooke, thanks as always for joining us. Appreciate it.
Great, thank you very much.
That is it for us on the street. Many thanks to Brooke Thackeray, research analyst at Global X, for joining us today. Lindsay Biscaya is up next with the Open. Trading gets underway a little more than 30 minutes from now. Have a great day.